Folks, I've been around a long time, nearly a century, and I've seen a lot of smart people make dumb mistakes with money. Here's a shocking admission from someone who's made a fortune investing. Most retirees, even the sharp ones, would have been far better off if they'd never tried picking individual stocks at all. Studies show that over 90% of active investors, including professionals, underperform a simple highlight index fund, tracking the market over the long haul. And for everyday folks like you in retirement, trying to beat the market often ends up costing you dearly, sometimes wiping out years of savings. I could have been twice as rich if I'd avoided a few of my own early blunders in stock picking, but curiosity got me. Why do so many of us fail at this game? And more importantly, what's the gentle path to doing better in your golden years? Stick with me. I'll share what I've learned the hard way, with some stories from my life and others, and a straightforward strategy that can help you sleep better at night. Folks, I've lived a long time, long enough to see bull markets, bear markets, crashes, booms, and everything in between. I've made a fair amount of money investing alongside Warren Buffett, and I've watched countless smart people do extraordinarily well. But here's a confession that might surprise you coming from someone like me. Most retirees, even the intelligent and disciplined ones, would have ended up with far more money, far less worry, and far better sleep if they had simply never tried to pick individual stocks at all. That's right. After all these decades, I'm telling you plainly that stock picking is a game where the odds are heavily stacked against the average person, especially in retirement. Studies going back years, whether from Dale Barr, Morningstar, or academic researchers, consistently show the same sobering reality. The vast majority of individual investors and even most professional fund managers underperform a simple, low-cost index fund that just owns the whole market. We're talking about gaps of 3, 4, sometimes 5 percentage points a year. Over 90% of active strategies lag the market over long periods. And for retirees drawing down their savings, that gap isn't just disappointing. It can be the difference between a comfortable life and running short in your later years. I could have been twice as rich myself if I'd avoided some of my own early mistakes in stock picking. There were times when I got greedy, stepped outside what I truly understood, or simply failed to sit still when patience was required. I learned those lessons the hard way, and fortunately I had enough good years to recover. But many people don't get that second chance, especially once they've stopped earning a paycheck. Now you might be thinking, Charlie, if it's so hard, why do so many of us try? That's a fair question, and it's exactly what I want to explore with you today. Because retirement is supposed to be the reward after decades of hard work, time with family, travel, hobbies, peace of mind. Yet I've watched too many good people turn those years into a period of quiet anxiety because they treated their life savings like a casino chip, jumping from one hot stock to another, chasing tips from friends or television pundits, convinced they could beat a system that chews up most professionals. I once knew a retired engineer, brilliant fellow, helped design aircraft for a major company, who spent his days glued to financial news after he left work. He was sure he could spot the next big thing. He poured a big chunk of his nest egg into a handful of technology stocks in the late 1990s because the internet is the future. When the dot-com bubble burst, his portfolio dropped by more than 60%. It took him over a decade just to get back to even, and by then he was in his late 70s, cutting back on things he'd dreamed of doing. He told me once with a rueful laugh, "Charlie, I was smart enough to earn it, but not smart enough to keep it simple." That story isn't rare. It's common, and it's painful to watch. The psychological traps are powerful. Overconfidence from past career success, boredom looking for excitement, the illusion that reading a few articles gives you an edge in a game played by thousands of full-time professionals with better information and faster computers. We think we're investing, but often we're just speculating without admitting it. But here's the encouraging part. And the reason I'm sharing all this with you today, you don't have to play that losing game. There is a straightforward, rational, almost gentle way to invest in retirement that sidesteps most of these traps, protects your capital, and still lets the extraordinary power of compounding work in your favor. It doesn't require genius. It doesn't require constant attention. It doesn't require you to outsmart the market. In fact, it works precisely because you stop trying to outsmart the market. Over the next half hour or so, I'm going to walk you through why most retirees struggle with stock picking, the common mental pitfalls that trip us up, the real stories, both successes and failures, I've witnessed over nearly a century, and most importantly, the simple principles that have served me and many others far better than frantic activity ever could. We'll talk about staying within your circle of competence, the magic of owning quality businesses for decades, and why a humble index fund is often the wisest choice most people can make. My goal isn't to scold anyone. Lord knows I've made my share of blunders. It's to offer you a calmer, more reliable path, one that lets you enjoy retirement instead of worrying about the daily gyrations of the ticker tape. So if you're listening to this and wondering whether there's a better way to handle your savings in these years, stick with me. What I've learned, often through painful experience, just might help you finish strong. Let me speak plainly to you, as one retiree to another, or soon to be. Retirement is the time when your money has to go to work full time because you no longer can. You've spent 40 or 50 years earning, saving, maybe raising a family, putting aside a little here and a little there. Now that nest egg has to carry you for another 20, 30, perhaps even 40 years. That's a tall order. It needs steady, reliable growth without wild swings that keep you awake at night. Yet here's what I've observed over nearly a century. The moment many people retire, they suddenly decide they're going to become expert stock pickers. They have the time, they have the savings, they have the interest, and they think, why leave money on the table? Why not try to do a little better than average? It sounds reasonable. It feels almost responsible. But in practice, for the overwhelming majority, it turns into one of the costliest mistakes of their financial lives. The numbers are brutal, and they've been brutal for decades. Every year, firms like Dalbar and Morningstar publish studies comparing what the average investor actually earns against what the market itself returned. The gap is staggering. Over the past 30 years, the S&P 500 has delivered something around 10% annualized. The average equity investor, closer to 4% or 5%, sometimes less. That's not because people are stupid. It's because they buy high out of excitement, sell low out of fear, chase yesterday's winners, and rack up fees and taxes along the way. In retirement, that gap isn't just disappointing, it can be devastating. A few percentage points a year, subtracted decade after decade while you're also withdrawing money to live, is the difference between running out at age 85 and leaving a legacy at 100. I remember a fellow I knew in California, a highly respected surgeon. Brilliant man, saved diligently his whole career. Retired at 65 with what most would consider a very comfortable 7-figure portfolio. He'd always left the investing to professionals, but once he had time on his hands, he started watching financial television, reading newsletters, talking to friends at the golf club. He became convinced he could pick individual stocks better than some mutual fund manager taking fees. So he moved a big portion of his savings into a handful of names he thought were the future, mostly technology and telecom in the late 1990s. He was enthusiastic, almost boyish about it. When the dot-com peak hit in early 2000, he was feeling pretty clever. Then the crash came. By 2002, that portion of his portfolio had lost more than 70%. He didn't lose everything. He had some bonds and other assets, but the damage was deep enough that he and his wife scaled back their travel plans, delayed helping their grandchildren with college, and spent years worrying, instead of enjoying the freedom they'd earned. He told me over lunch one day, with that self-deprecating chuckle some of us older folks develop, "Charlie, I spent 40 years learning how to repair hearts without killing people. You'd think I'd have realized I didn't suddenly become an expert at picking stocks just because I had time to watch CNBC." That story repeats itself in different forms across generations. I saw it again in the mid-2000s with real estate and bank stocks, and again in 2021 with all the excitement around speculative names and meme stocks. Retirees, more than any other group, get drawn in because they have the capital and the leisure to act on impulses that working people simply don't have time for. The psychological traps are insidious. First, there's overconfidence from past success. You ran a business or a department or a medical practice, and you were good at it. You made smart decisions under pressure. It's easy to believe that same intelligence will translate to the stock market, but the market is different. It's a giant, efficient, humbling machine full of people trying just as hard as you are, many with far better tools and information. Second, there's boredom. After a lifetime of structure and purpose, retirement can feel empty. Monitoring stocks, reading earnings reports, debating picks with friends, it gives the days shape and excitement. It feels productive. But excitement in investing is usually the enemy of good results. Third, there's the illusion of control. When you own an index fund, you're admitting you're average. When you pick individual stocks, you're declaring you're going to be above average. That feels better until reality sets in. The consequence of all this is quiet but profound. Instead of enjoying the fruits of a lifetime of labor, too many retirees spend their later years anxious about money, second-guessing decisions, watching the market every day, and often ending up with less than they would have had if they'd done absolutely nothing fancy at all. But please hear me clearly. This isn't inevitable. It's avoidable. There is a calmer, more rational path that doesn't require genius or constant vigilance. It simply requires recognizing the reality of the game we're playing and choosing not to play it on the hardest difficulty setting. In the next chapters, we'll look at the specific mistakes that trap most would-be stock pickers, then turn to the principles and strategies that have worked far better for far more people, including, eventually, for me. The good news is that the solution is gentle, straightforward, and available to every one of you listening today. Let's get down to brass tacks. I've made plenty of mistakes myself in this game, so I'm not up here wagging a finger at anyone. I'm just an old man who's seen the same patterns repeat themselves for 90-plus years, and I'd like to spare you some unnecessary grief. The fundamental reason most retirees fail at stock picking is simple. They're playing a game that is extraordinarily difficult to win without possessing the rare combination of temperament, knowledge, and discipline that the very few winners have. It's not that people are dumb. Far from it. It's that the market is a giant, efficient, humbling mechanism that punishes overconfidence and rewards patience, yet most of us bring exactly the wrong instincts to it. Let me list the big traps I've watched people fall into time and again. First and most important is stepping outside your circle of competence. I've hammered this point for decades. You have to know the edge of your own ability and stay strictly inside it. Most retirees don't. They read a few articles, watch a few interviews, hear a tip at the country club, and suddenly they think they understand a complex business. I knew a very successful lawyer in Los Angeles, sharp as a tack, argued cases before the Supreme Court, who retired and decided he could pick energy stocks because oil was in the news. He loaded up on a couple of shale drillers in 2014, right when prices were high, and everyone thought the boom would last forever. By 2016, oil crashed. Many of those companies went bankrupt, and he lost about 80% of the money he'd put in. He laughed about it later and said, "Charlie, I knew the law inside out, but I didn't know the difference between upstream and midstream." That's the circle of competence in action. Second trap, confusing activity with productivity. Stock picking feels like work. You research, you read earnings reports, you make lists, you buy and sell. It keeps the mind occupied. But activity is usually the enemy of good investment results. Every trade costs money in commissions or spreads, triggers taxes if you're not in a retirement account, and, most damaging, gives you endless opportunities to buy high and sell low. The data are clear. The more often investors trade, the worse they do. High turnover portfolios underperform low turnover ones by wide margins. Third, the deadly sin of impatience. The really big money in stocks has always been made by holding great businesses for decades while compounding works its magic. Yet most people, especially in retirement, can't sit still. They see a stock go up 20% and want to take profits. They see it go down 20% and panic. They chase what's hot and flee what's cold. I ran my own investment partnership in the 1960s and early 1970s, and I beat the market handily for 14 years. But even I got impatient at times and sold things too soon, or bought things I shouldn't have. Fourth, overconfidence fueled by a little knowledge. A retiree reads that a company has a low price-to-earnings ratio and thinks, it's cheap, but cheap stocks are often cheap for a reason. No growth, declining industry, heavy debt, incompetent management. I knew a group of retired engineers in Pasadena who formed an investment club. They were meticulous, spreadsheets, discounted cash flow models, the works. They bought undervalued stocks with precision. Over 15 years, they still lagged a simple index fund by several percentage points a year. Why? They overestimated how much their analysis actually told them, and they missed the few truly great compounding machines that drive market returns. Fifth, the siren song of excitement. Let's be honest. Watching a stock double in a year feels thrilling. Owning an index fund and earning 10% feels boring, but thrill usually comes with risk that isn't properly priced. I've described the stock market as a pari-mutuel system where the crowd is usually right in the short run, and you have to be extremely patient and selective to win in the long run. Most retirees don't have the temperament to wait 10 or 20 years for their few good ideas to play out. I'll give you another personal example with a bit of self-deprecation. Early on, before I teamed up with Warren, I concentrated heavily in a few ideas, which was good, but some of those ideas were outside what I really understood deeply. One in particular, a trading company, looked statistically cheap and had a long history. I put a big chunk of my partnership into it. It turned out to have hidden problems, and it performed poorly for years, cost me a lot of compounded return. I learned it's not enough to be smart. You have to be smart about things you truly grasp, and you have to avoid stupidity more than you seek brilliance. Invert the problem, as I like to do. If you want to fail at stock picking, just do the following. Trade frequently. Buy things you don't understand deeply. Chase excitement. Sell winners too soon. Hold losers too long. And believe that past performance or current headlines give you an edge. Most people do several of these, and the result is entirely predictable. Mediocre or worse returns when they need solid ones the most. The consequence in retirement is not abstract. It's smaller trips, delayed gifts to grandchildren, moving to a smaller house, or simply the quiet anxiety of watching your savings shrink faster than you hoped. I've seen it too many times, and it's entirely avoidable. But take heart. Recognizing these traps is half the battle. In the next chapter, we'll turn to the encouraging side, what actually works for ordinary people who want reliable growth without the heartache. Now let's turn to the encouraging side of this conversation. After all the blunt talk about mistakes and traps, you might be wondering if there's any sensible way left to invest in retirement. The answer is yes, absolutely yes, and it's far simpler and more reliable than most people imagine. Here's the core truth I've come to after a lifetime in this business. For the vast majority of people, including nearly all retirees, the single best strategy is to own low-cost index funds and do virtually nothing else. No stock picking, no timing the market, no chasing hot sectors, no paying high fees to managers who promise to beat the averages but almost never do over the long run. I've said it many times, and I'll say it again here plainly. If you don't have a clear edge as a stock picker, and very few people truly do, then just buy a broad index fund, preferably one tracking the S&P 500, and sit tight. Let the American economy and the extraordinary power of compounding do the work for you. It's rational, it's low stress, and historically it has delivered wealth to ordinary investors far more reliably than the frantic efforts of most active stock pickers. Think about it. The S&P 500 represents ownership in 500 of the strongest, most adaptive companies in the world. Over any long period, 20, 30, 40 years, these businesses in aggregate have grown earnings, raised dividends, and compounded capital at a remarkable rate. An investor who simply owned that index through thick and thin has been richly rewarded. You don't have to be brilliant. You just have to avoid being stupid enough to interrupt the process with needless activity. Now, I'm not a purist who says no one should ever own individual stocks. Warren and I have spent our lives doing exactly that at Berkshire Hathaway, and I personally own a handful of common stocks outside of Berkshire. But I do so only when I'm operating well inside my circle of competence, when I can buy a truly wonderful business at a fair price, and when I have the temperament to hold it essentially forever. For me, that has meant companies like Costco, which I've owned for decades because I deeply understood their model. Membership fees creating a recurring revenue stream, ruthless efficiency, loyal customers who shop there almost religiously. I bought it when it was reasonably priced, and I've simply held on as the business has compounded value year after year. That's the key distinction. If you're going to pick individual stocks at all, and most retirees are far better off not doing so, then you must restrict yourself to a tiny handful of exceptional businesses you understand thoroughly. Buy them when they're not wildly overpriced, and then do the hardest part. Sit on your hands for decades while compounding works. Most people can't or won't do that. They tinker, they get impatient, they read something alarming and sell, they hear about the next big thing and rotate. That's why the simple index fund route is so powerful. It removes human error from the equation almost entirely. Let me give you the principle in inverted form, because inversion has always helped me think clearly. If you want to do worse than the market in retirement, do the following. Pay high fees, trade frequently, chase performance, buy stories instead of businesses, and panic during downturns. The index fund strategy avoids all of those stupidities automatically. A practical way to think about it. Allocate the bulk of your equity exposure, say 60% to 80% depending on your age and comfort, to a low-cost S&P 500 index fund. Put the rest in high-quality bonds or a bond index fund for stability and income. Rebalance once a year if things get out of whack, and otherwise leave it alone. No daily checking, No reacting to headlines, no second guessing. You'll sleep better, worry less, and over time you'll almost certainly end up with more money than if you'd spent those years trying to outsmart everyone else. I switched much of my own thinking on this decades ago. Early in my career, I ran a concentrated partnership and did very well picking stocks. But I also recognized that what worked for me, with my peculiar temperament and decades of study, wouldn't work for most people. Even many professionals can't beat the index consistently. Why should a retired doctor or teacher or engineer expect to do better in their spare time? The beauty of this approach is its gentleness. Retirement should be a time of peace, not a second career managing a portfolio. Index funds give you that peace. They give you broad diversification, low costs, tax efficiency and taxable accounts, and the full upside of American capitalism without the downside of individual company blow-ups or personal misjudgments. If you feel you must own a few individual stocks for intellectual stimulation, and I understand that urge, limit it to a small portion of your portfolio, say 10% or 20%. Choose only businesses with durable competitive advantages, wide moats as we call them, pricing power, high returns on capital, honest and capable management. Buy them when the price is reasonable, not when the crowd is euphoric, and then commit to holding them through thick and thin, because the real wealth is created in years 10, 20, and 30, not years 1 through 5. That's how compounding rewards patience. A good business bought at a fair price and held for decades can turn modest sums into fortunes, but it requires the discipline to do nothing most of the time. So the core strategy is this: default to simplicity and humility with index funds. If you have genuine competence and temperament, add a very small number of high-quality individual holdings. Either way, prioritize avoiding stupidity over seeking brilliance. That's the path that has worked for far more people than the flashy, active approach ever has. In the next chapter, I'll share some real stories, both triumphs and tragedies, that bring these ideas to life. Let me bring all this to life with some real stories. I've always found that principles stick better when you see them play out in actual lives. Successes to emulate, failures to avoid. I'll share a handful here, some from people I knew personally, some from broader history, and a couple involving my own decisions, warts and all. First, a cautionary tale of stock picking gone wrong. I knew a retired executive from a major Omaha company. Fine fellow, prudent in most things. After he retired in the early 1990s, he decided to manage his own portfolio actively. He had a decent nest egg and he liked the intellectual challenge. He focused on what he thought were value stocks, companies trading at low multiples, often in declining or cyclical industries. One of his biggest positions was in a large railroad that looked statistically cheap, trading at a fraction of book value, decent dividend, long history. Sounded rational, but railroads in the 1990s faced brutal competition from trucking, rising fuel costs, and regulatory headaches. The business had no real moat left. Over the next 15 years, that stock barely budged while inflation and the broader market marched higher. Adjusted for inflation, he lost money on it. Meanwhile, a simple S&P 500 index fund more than quadrupled in that same period. He didn't lose everything, he had other holdings. But that one big idea cost him hundreds of thousands in opportunity and years of quiet frustration. He admitted to me once, "Charlie, I thought I was buying a bargain. Turns out I was buying a melting ice cube." Contrast that with one of my own better decisions, See's Candies. Warren and I bought See's in 1972 for $25 million through Berkshire. It was a wonderful business. Strong brand, pricing power, high returns on capital, happy customers who paid premium prices for boxed chocolates. We understood candy and California consumer behavior deeply. That $25 million purchase has generated well over $2 billion pre-tax earnings for Berkshire since then. Not because we were geniuses, but because we bought a truly high-quality business at a fair price and simply held on while it compounded. That's the power of owning something exceptional and doing nothing. Another personal favorite, Costco. I've owned shares personally for decades, separate from Berkshire. I understood their model intimately. Membership fees creating a virtuous circle, extreme efficiency, treasure hunt merchandising, treating employees and customers well. I first bought in the 1990s when the stock was reasonably priced relative to its growth prospects. It's been one of the best performing large stocks in America since then, turning a modest investment into a very large one. But notice, I stayed strictly within my circle of competence. I knew retail, I knew consumer behavior, I knew honest management when I saw it. I didn't chase biotech or semiconductors or whatever was trendy. Now a failure from someone close to the investing world. I knew a physician in Southern California, highly intelligent, disciplined saver, who retired around 1998. He got excited about the internet boom and decided this was his chance to accelerate his wealth. He moved a large portion of his portfolio into growth stocks, including several high-flying biotech and tech names promising revolutionary breakthroughs. One in particular was a genomics company that soared during the bubble. When the crash came in 2000-2002, that stock fell over 95%. His overall portfolio dropped by more than half. It took him until the mid-2010s just to recover nominally, and by then inflation had eaten much of the real value. He told me later with characteristic self-deprecation, "I let greed and excitement override everything I knew about prudent investing." On the encouraging side, I had a friend, a former school teacher who retired in her mid-60s, who took the opposite approach. She had saved steadily but wasn't wealthy. After reading some basic investing books, she decided she had no edge in stock picking and no interest in the stress. She put virtually everything into a low-cost Vanguard S&P 500 index fund and a bond fund, rebalanced once a year, and otherwise ignored it. No daily checking, no reacting to headlines. Over the next 25 years, through crashes and booms, her portfolio grew steadily. She traveled extensively, helped her grandchildren with education, and lived comfortably without ever worrying about running out. Simple, boring, effective. Historical example: the Nifty 50 era in the late 1960s and early 1970s. These were the one-decision stocks. Supposedly great companies like Xerox, Polaroid, Avon, IBM, you could buy and hold forever. Institutional investors and many individuals piled in at sky-high valuations. When the 1973-74 bear market hit, those stocks crashed 70%, 80%, even 90% in some cases. Many never recovered their old highs in real terms. Lesson: even truly good businesses can be terrible investments if you pay too much. My own partnership years offer another illustration. From 1962 to 1975, I ran a concentrated portfolio, usually holding just a handful of ideas. I beat the Dow Jones Industrial Average by a wide margin, over 20% annualized for the partnership versus about 5% for the Dow. But it wasn't because I picked dozens of stocks. It was because I waited patiently for a few situations where I had deep conviction, bet heavily within my competence, and held through volatility. Most people can't or won't do that consistently. Even I closed the partnership in 1975, partly because I thought the opportunities were getting scarcer, and I preferred the Berkshire structure. These stories, successes and failures, share a common thread. The big winners came from owning either A, the entire market through an index at low cost, or B, a very small number of truly exceptional businesses, deeply understood, bought sensibly, and held for decades. The big losers came from overconfidence, activity, stepping outside competence, paying too much, or simply interrupting compounding with impatience. You don't need to be in the tiny minority who can do the second path successfully. The first path, index funds, is open to everyone and has made more ordinary investors wealthy than all the clever stock picking in history combined. All right, we've covered the problems, the traps, the stories. Now let's make this useful. I'm not here to just tell you what not to do. I want you to leave this conversation with a clear, gentle plan you can start on tomorrow without overwhelm or second guessing. Here are the straightforward steps I'd suggest to any retiree listening. Steps that have worked for many people I've known and that reflect what I wish I'd fully embraced earlier in my own journey. First step, honestly assess your circle of competence when it comes to investing. Sit down with a piece of paper and write out the businesses or industries you truly understand deeply, not from reading a few articles, but from decades of real experience or careful study. For most retirees, that list will be short. Maybe consumer goods if you ran a store, or healthcare if you were a doctor or nurse, or perhaps nothing at all beyond broad market behavior. Be brutally honest, the way I've had to be with myself. If genuine stock picking isn't on that list, and for nearly everyone it isn't, then make the rational decision. Commit to low-cost index funds as your primary vehicle. There's no shame in it, it's wisdom. Second step, simplify your portfolio dramatically. Move the equity portion, whatever percentage feels comfortable given your age and need for income, into one or two broad, low-cost index funds. My strong preference is a fund tracking the S&P 500 from a reputable provider like Vanguard or Fidelity, with expense ratios under 0.1%. It's essentially owning a slice of the strongest companies in the world, automatically rebalanced, with almost no fees eating into your returns. Put the more conservative portion into a high-quality bond index fund or individual treasuries for stability and income. A common starting point for someone in their 70s might be 50-60% stocks and 40-50% bonds, but adjust based on your own sleep well at night level. Third step, commit to minimal activity. Rebalance once a year, perhaps on your birthday or New Year's, to bring things back to your target allocation if markets have pushed them out of whack. Otherwise, do nothing. No checking prices daily, no reacting to headlines about recessions or elections or Fed meetings. Turn off the financial television. The less you tinker, the better compounding can work. I've seen too many people derail perfectly good plans by making unnecessary changes. Fourth step, if you feel you must own a few individual stocks for intellectual engagement, and I do understand that itch, limit it strictly. Allocate no more than 10-20% of your portfolio to 3, maybe 4, wonderful businesses you understand intimately, with durable competitive advantages, honest management, and a history of treating shareholders well. Buy them only when the price is reasonable, not when the crowd is euphoric, and then make the ironclad commitment to hold them for decades through ups and downs, unless the fundamental story breaks. Examples: I've lived by Costco or companies like Apple or Johnson & Johnson if you truly grasp their moats. But if you can't name the moat in one sentence, stay away. Fifth step, protect yourself by inverting daily temptations. Every time you're tempted to make a trade, ask yourself, is this likely to add to my long-term wealth, or is it just activity disguised as productivity? More often than not, the answer will be the latter. Ask, what stupid thing could deplete my savings fastest? High fees, frequent trading, panic selling, chasing hot tips. Avoid those like the plague. Build safeguards. Don't keep brokerage apps on your phone. Don't subscribe to newsletters promising hot picks. And consider having a trusted advisor or family member as a sounding board to talk you out of impulsive moves. Sixth step, plan for withdrawals thoughtfully. In retirement, you're spending down as well as growing. A reasonable rule of thumb many have used successfully is to withdraw no more than 4% of your portfolio in the first year, then adjust upward for inflation each year thereafter. If markets are down sharply, consider cutting back temporarily to preserve capital. The goal is to make your money last as long as you do, ideally longer. I followed a version of this myself later in life. After years of concentrated stock picking in my partnership and at Berkshire, I recognized that for my personal holdings outside Berkshire, simplicity and quality were the wisest path. I own a handful of stocks I understand deeply, plus broad exposure through Berkshire itself, and I touch almost nothing. It's peaceful, and it's worked. These steps aren't exciting. They won't make you the star of dinner party conversations about the latest hot stock, but they will almost certainly leave you with more money, far less worry, and the freedom to enjoy the retirement you've earned. That's the real prize. Take one step this week, perhaps opening an account at a low-cost provider if you don't have one, or moving a portion into an index fund. Small, calm actions compound into large results, just like your investments will. We've come to the end of our time together, and I've enjoyed sharing these thoughts with you. I've been blunt at times. Lord knows I've made my share of mistakes, and I've seen plenty more, but everything I've said comes from a place of genuine care. Retirement should be the gentlest, most rewarding chapter of your life, not a period shadowed by financial worry or regret over decisions that can't be undone. So let me leave you with one final warning, delivered kindly but firmly. If you ignore the lessons we've discussed, if you continue trying to pick individual stocks without a clear, enduring edge, chasing excitement, trading frequently, stepping outside what you truly understand, or interrupting the miracle of compounding with needless activity, you will almost certainly join the vast majority who end up with less money and more stress than they needed to have. The market is a humbling teacher, and it rarely spares those who overestimate their abilities or underestimate its efficiency. I have watched good, intelligent people diminish their hard-earned savings this way, and it's painful every single time. But the encouraging truth, the wonderful, liberating truth, is that you don't have to play that difficult game at all. You can choose the calm, rational path instead. Low-cost index funds for the bulk of your portfolio, perhaps a very small handful of truly exceptional businesses if you have genuine competence and iron discipline, and then the quiet patience to let time and compounding do their work. This approach has enriched far more ordinary investors than all the clever stock picking in history ever has. It will give you steady growth, genuine peace of mind, and the freedom to focus on what really matters in these years: family, friends, health, experiences, leaving a legacy if you wish. I've lived this myself. After a lifetime of intense investing, running my partnership, building Berkshire with Warren, concentrating on a few great ideas, I eventually settled into a simpler personal approach outside of Berkshire. A few wonderful stocks I understand deeply, broad exposure through the company, and almost no activity. It's been peaceful, and it's compounded nicely. You can do something similar, tailored to your own circumstances, and finish strong. Take the ideas that resonated with you and act on one or two this week. Move some money into a low-cost index fund if you haven't already. Turn off the financial news. Write down your circle of competence and respect its boundaries. Small, sensible steps today will compound into large differences tomorrow, not just in your portfolio, but in the quality of your days. Thank you for spending this time with me. I hope it's been helpful. If these thoughts struck a chord, you might find more straightforward wisdom in some of the other discussions we've had, perhaps on the power of compounding in greater depth, or Warren's own lessons on life and investing. No pressure at all, just quiet ideas for your journey.